everyone and welcome back to our YouTube channel. मैं हूँ आपके साथ चारू and we are back again with the next episode of हम दो हमारे दो. मेरे दलाल स्ट्रीट के दोस्तों, if you have really liked the videos which are posted by us, then do please praise our team in the comment section and also share this video with maximum number of people. Also hit the like option and subscribe to the YouTube channel. And again, if you have any doubts, any questions about the stocks, you can comment in the comment section below and we will revert you for that. So in this episode of Hum Do Hamare Do, we have done gold digging from Nifty 50 stocks and we eventually identified two new fundamentally sound mid caps for your long-term investment growth story. So once again, hello and welcome to my season of becoming friends with the Dalal Street Mates. So we are consistently giving you tips which are fundamentally sound, and today also both the selected stocks are cheaper valued government owned companies. So let's start. The first one which we have is Bharat Petroleum Corporation Limited, which is BPCL. So the current market price is around rupees 375 to 380 and target price is around rupees 450 in 1 year holding period. Let's start with fundamental analysis. The main stock price trigger will be disinvestment of government stake in this profitable PSU stock. And BPCL is a leading player in the Indian petroleum industry with operations in both refining and marketing segments. The only silver lining is the improved outlook for retail margins earned by the company when crude oil price is lower than US dollars 40 to 50 per barrel crude oil. It is one of the largest oil and gas companies in India. In this budget upcoming on February 1st, 2021, there is an excise duty cut expected which may put this stock on fire. BPCL's Bina Refinery and Kochi Refinery by financial year 2021 are fully operational now and stable with further boost profitability. Discoveries in Mozambique and Brazil provide good opportunity for company to enhance its footprint in the E&P space. Refinery throughput reached 73 to 74% of Q2 financial year 2020 and management expects 85% to 90% of Q3 financial year 2021 as festive season demands pick up. Now the technical analysis. Double bottom has been seen in the stock in 2016 and 2018. From that point, it gave good returns. The stock keeps giving big price movements whenever the talks of disinvestment picks up speed. So do keep track of the stock as there can be strong bouts of volatility. For the long term, the stock is an evergreen performer given India's larger oil and gas market. There has been small trend lines coupled with triangle patterns which makes stock display unpredictability and doesn't offer opportunity to short-term traders. It can only be a stock for risky long-term investors who are banking on twin returns of huge dividend income and share price appreciation from support to resistant levels. So medium to long-term target is around 450 and dividend declared consistently is lucrative, which makes the stock a must-have in any ideal investor's portfolio by adding on dips and selling on rise. It can be used for long-term traders only as the stock has experience of consolidating for abnormally longer periods which tests patience of short-term investors adversely. So only long-term to medium-term return is looking practically possible to bank your money on. The next stock which we recommend is Indian Oil Corporation Limited, which is IOCL. The current market price is around 90 rupees and target price is around rupees 150 in 1 to 2 years holding period. Fundamental analysis. Improved outlook for retail margins due to lower crude oil prices. It is trading at a compellingly cheaper valuation post the sharp 45% fall in the stock price in the last 1 year that has priced in worries over policy by volatility in margins and likely risk of increasing competition from private retailers by alternative fuels. It has bottomed out and now there is only upside looking possible. Reported Q2 financial year 2021 standalone EBITDA up 163.9% year on year at rupees 94.272 billion. This was driven by massive swing from loss of rupees 20.3 billion in Q2 financial year 2020 to a profit of rupees 40.77 billion in refining, 56.5% year on year, a rise in petchem and 8 times growth in other segment. Gross standalone debt declined from rupees 1.16 trillion in March 2020 to rupees 915 billion in September 2020 due to lower working capital needs and reduced cooking fuel subsidy dues, down from rupees 110 billion to rupees 91.6 billion. Gross debt declined to rupees 915 billion of end September 2020 versus rupees 1.16 trillion in March 2020. The subsidy receivables fell from rupees 110 billion to rupees 91 billion in September 2020 and rupees 72 billion in October 2020. IOC expects to add 2,000 to 2,500 outlets each year at a capex of rupees 15 to 20 billion, which implies low-cost outlets. These positive factors make us recommend that company will deliver strong performance banking on a strong positive economic outlook. We maintain our buy on the stock with a medium to long-term target price of rupees 150 per stock. Now we move on to the technical analysis. So going from the long-term price chart, the stock prices moved consistently downwards since 2017 levels of around 225 and then crashing down to 70 odd levels. Still, it's just gone up 20 rupees despite Sensex hitting 50,000 points and lockdown easing footfall. So with positive expectation such as excise cut, etc., one can safely plan their money in this low price, attractively valued stock. The long-term growth story of Indian oil demand is intact. So these dips are opportunities to go long on this stock for the long term. Rupees 150 is the expected price for the long term. We would recommend to buy this stock before budget on February 1 to take a chance of making quick bucks if in case excise duty cut is announced on fuels. The long-term trend line is intact, but that indicates that only long-term investors who put away the stock out of sight for long-term will only be able to hold this patient testing stock. It is the government company which moves up last when markets are trading positively in the green, but falls first when stock markets falls in the red. So only long-term players can consider this. We recommend to buy on long-term basis. And so guys, I hoped you like this video, and do share this videos with your family, friends, relatives, and all the social media platforms, and do at least 2 comments and ask our friends to become our mates in the Dalal Street. And a significant amount of positive response generated in the previous videos have motivated the investors and the creators of this content to mass produce more and more gold digging stock videos. And we will be back soon with other better professional content in our next part. Till then, thank you.